Good morning. This is Ken Long from Tortoise Capital Management with a review of the weekend trading report for October 5th, 2013. We have a market that's in bullish normal condition. On an annual basis, using weekly RSI 14, we're at 61 out of 100, or the higher end of normal. On a 10-day basis, we're halfway towards oversold conditions with a score of 37 out of 100. Looking at the market mosaic, price relative to the 200-day moving average is red bullish at 6.19%. That means we're 4.19% buffer away from the sideways market condition, which occurs when price gets within 2% of the 200-day moving average. The slope of the 50-day moving average actually went negative and is now red bearish at minus 0.02%. When the slope of the 50 is actually negative, that's not been healthy for the market in the intermediate swing term. The intermediate strength of trend using ADX 14 is now officially weak at 14.0. The threshold is 15, so we have an exceptionally non-trending market. ATR percentage, measure of volatility, is at 0.90%, which is normal. The risk index, which is the VIX 30-period moving average divided by the 10-period moving average, comes in at a score of 0.97. That is risk off condition. If we take that number and compare it to the last 5,000 trading days and take the z-score, we're at minus 0.42%. This is a 90-day time series of that risk index, and you can see that on this last oscillation up, the volatility never really got as quiet as it did on the previous cycle when it got all the way up to a z-score of 2. It's now dipped into the negative side again, and that's risky for the market. Looking at blended monthly rebalancing, these are updated holdings. I sent an email out earlier this week. Your version of the weekend report may not have been updated. I have just corrected that. So the ETF 13s are the Qs, US small caps, and then the Euro Asia blend. Same with ETF 22. Then ETF 32 now features the European 350, US technology, and then the BRIC companies, EEB. Next reevaluation is due on or about 1 November. Theoretical exposure in ETF2 is at 100%. The model portfolio will be at 100%. Just taking a quick look at current strengths. You can see most are on a buy signal in ETF 13 with the Qs, Euro Asia blend in the small caps. Only US real estate, diamonds, and treasuries are on cash position. Top three in the ETF 32 are European 350, now China, and the BRICS. I've added the top 50 out of the ETF Max listing, and that's like about 1,400 or so ETFs. And just to get a sense of where the real uber strength is for those of you looking for more. TAN, the solar ETF, remains at the top. Solar energy again, KWT. This version of the Golden Dragon Index, PGJ, some remarkable numbers. I'll continue to add this each week. Looking at the market health check, we have the dark blue shaded area is the 30-period Bollinger Band plus or minus 1. That's the river. The lighter blue shaded area is plus or minus 2 standard deviations. It's the floodplain. The shaded red area in the middle is a 10-period Bollinger Band plus or minus zero point 0.5. We think of that as the undercurrent, or we're calling it the dragon. And that sort of gives a preview of coming attractions, where the river is heading next. You can see that has rolled over. You can see price is right at the Bollinger Band mean, right in the middle of the river in the noise. The darker blue channel here is a 10-period RAF regression channel. You see the slope is downward following the dragon. The black channel is a 30-period RAF regression channel. That's the intermediate term trend. That's facing up, but with price testing the bottom of that channel. So buy on dip opportunity is certainly developing for those of you interested in the long side. The green channel is the 90 period or the long-term RAF regression channel. That's also facing up. That's the long-term bullish nature of the market expressing itself. Horizontal purple lines are resistance levels that are price targets now that have been resistance in the past. We really got to see price above 173 to believe in the resumption of the bull. Meanwhile, we have tactical trades available with upside price targets at 170 and 173. The horizontal red lines represent support levels that have held in the past and would be downside targets in the event of further market failure. So those key support levels at 167, about 162 and 3/4, around 160, and then down below the 200 here at about 166 and a half. This oscillating black line in the background is the slope of that 30-period regression line. I've just indicated some important points in the life cycle of that sine wave when it's been as steep down as it ever got in the pullback. When it crosses the zero line and goes positive, the highest upward slope that it's achieved, and you can see that we're in this sine wave right now, made a lower high with respect to the previous peak, and has started to roll over, and so that's problematic. That's troubling. You combine that with the relentless upward move of the 200 period moving average, and you can see that we're running out of tactical trading time here for that bull to get back to the strength that helped it achieve this 173. So I think we have a perfect setup here for shorter term traders because we have reasonable upside profit targets and downside targets, and an increase of volatility here. So we're getting some large intraday moves, but no follow through. And so once the political shenanigans are resolved, I would expect to start seeing some directional moves. And with ADX, as you can see now down below 15, with bears slightly in charge, we have the stage set for strong moves out of this entire almost 60-day consolidation period. Just coming out of oversold conditions on percent R, the percent price oscillator is pointing towards the downside with the jaws of the dragon open to the downside, which suggests a test back to 167 and then further to 163. Really, it's price falling out of the river here at 165 would be a crucial signal. So we do have favorable reward to risk in the short term in both directions with increased volatility, and that's going to favor the intraday and the shorter term tactical trade. Quick look at the ETF2 regional report. All of the primary indexes are on a buy signal. That puts us at 100% invested, 0% cash in the theoretical model. Right now, EFA at 47 is stronger than the U.S. at 43, so the globals are favored over the U.S. right now. Inside the U.S., the strength is in technology at 48, then small caps 47, mid caps 45, and now the U.S. large caps pulling up the rear at 43. And S&P, which was the strongest sector by far in the first 6 months of the year, has now decayed and become one of the weakest ones, noted in the yellow here. Two strongest sectors, European 350 and then U.S. technology. The two weakest sectors, Latin America and Japan. That should read EWJ, sorry. Inside the U.S. sector, spiders, you can now see the weakness creeping in across the board as yellow has now come on board. The strongest sectors right now being materials, healthcare, and consumer discretionary. And now consumer staples have actually gone on a cash position. They've been the strong sector for most of the year. World market model, now expanding that analysis an extra layer. You can see the U.S. is above average except for the Dow and the S&P, which have now pulled back into the yellow. Everything Europe strong. Asia less Japan is above average. Real strength in China, South Korea. Otherwise, some weakness creeping in. Canada and Brazil have now come above average. Mexico still lagging among the other asset classes. Everything weak, but exceptional weakness in U.S. real estate and long-term treasuries. Top ETF 30s, solar, China, clean energy, Spain and Italy. Biotech remains strong. Those that are in the green in strength but white in consistency are places where strength is continuing to emerge. And so GXC, China, is an example of that, along with Poland, natural gas, South Korea, Austria, France, or not France, I'm sorry, just Austria, Germany, China, energy. Here's the European 350 index IEV, so it's kind of unusual to see a large index like that getting into the, among the growth leaders, and so that continues the narrative we've seen unfolding over the last 6 or 7 weeks. Looking at the Dow 30 through that same lens, many more now in the red based on the pullbacks in the market this week, based on the financial ineptitude in Washington. And in most cases, you see that the strength column is much weaker than the relative consistency, and that's a broad-based weakness of the U.S. That's not a company story, that's a market and country story. Shifting to the day report, we got a ton of quality setups and channeling overreaction, 5 days down and triple screens, and the 551Ws across the board. A ton that are also testing out well on the auto framer, and so I won't read those all to you, but it is a target-rich environment going forward. No signals in overreaction or channeling. Goldman Sachs, interesting. It's got a RSI2 value of 6, fraud quality of 3.1. It was a big percent loser on Friday, and test out at 9.9 to 1 on the auto framer, and is both a channeling and an overreaction signal. Cisco, Coke, Chevron, and Procter & Gamble round out the top 5 on the max pain range compression. Just noticed Chevron at a 0 on RSI2, with Walmart and McDonald's both in single digits. Walmart and McDonald's both testing out at least 5 to 1, 4.8 for Walmart, but and 7.5 for McDonald's. So that's an opportunity to buy some real quality if the numbers work out right, or the price works out right on Monday. Lots of 551 candidates. Looking at the ETFs, nothing tests out on the RSI2 screen. Gold and U.S. real estate were big losers Friday, along with the VIX and Treasuries. And a ton of 551W candidates, plenty to choose from on the auto framer, and then from the max pain range compression. The auto framer, just for reference, and framing data is provided. You can see the almost 10 to 1 reward to risk for Goldman Sachs. 30-day regression line in blue. The slope of that is reflected here in the time series. It's come back and now crossing its 10-period moving average as it rolls over, starting to decay from this previous upward strong move. You can see how that fits on the 10 or on the 6 month time series. Weakness in the percent stretch coming back to more than one standard deviation below the 6 month average. And you can see that the polynomial trend fitting line has crossed the 30, is now pointing downward as well. So weakness in the market and an increase in volatility here as measured by the ATR percentage and also by the standard deviation divided by price. So we're at on that measure, we're at the 6 month average, just about at the 6 month average on the shorter term volatility as well. So the market is poised on a knife edge here, ready to respond to Congress. Very hard to get to be directionally biased here unless you have a political opinion. And that concludes the weekend report. I'll just flash through the remaining charts here for you to review, but without comment. Except for this comment, just notice the relative weakness in the Dow based, I think, the rebalancing, and then a lot of the three companies that moved in had a strong financial component, and that whole sector has gotten smashed in the last week, and so I think that accounts for the anomaly of the Dow compared to the other U.S. indexes. So, this is Ken Long from Tortoise Capital. Keep your powder dry and your risk measured, and thanks for your kind attention.